Hycroft mining has been one of the most popular stocks so far in the year, and right now the news are pretty good for what's about to happen next. How's it going? What is the latest situation? And more importantly, what should be our trading strategy in reflection of all this? In this video, we're going to talk about Hycroft mining, trading under the ticker symbol HYMC. At the moment, the financial market is very volatile, and we have to be careful about which stocks to buy, as well as the exposure and the timing of our trades. This video will cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events when you see it. If that is the case, I will then make follow-up videos to reflect those events. With that being said, let's jump into today's topic. During the most recent trading session, the stock increased to $1.24 before closing the trading day at $1.33. We should pay attention to the $1.21 level nearby because it was tested as a significant support level, which can be used as a solid level to determine if the bulls are still in the game. Over the past 30 days, the trend of the stock has clearly been bullish, because the market is now caught up with the potentials behind the fundamentals of a large gold deposit and the short squeeze dynamic that is going on with the moment. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bullish, considering the fact that the price action has had its fair share of ups and downs over the past few months, but the ups are definitely sufficiently significant for us to be talking about it here. When we look at the price trend overall, it's been holding its space at the moment, which allows both sides to regroup and to start again soon, as the upcoming few weeks are expected to be very significant in both volume and price volatility. The trading volume of Hycroft mining has recently been 60 million shares, compared to an average volume of 80 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $6.48. The market cap of Hycroft mining is currently at $79 million versus an enterprise value of $229 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts, or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it may assume to have a better management team, a stronger brand recognition, and a bigger online following. It's what makes this company unique compared to other alternatives. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value since the enterprise value is less reactive, especially in very volatile situations. If the company goes to liquidation, there won't be any goodwill, and the shareholders and bondholders would be left distributing amongst each other what's left on the balance sheet, which is going to be a lot less than what we currently see. When we compare the current price to the historical price fluctuations, the stock is 351% higher than the 1-month low, 351% higher than the 3-month low, and 351% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to head next, the implied volatility is 253%. Versus a historical volatility of 446%. The put-call volume ratio is currently at 0.05. It's normal for most stocks to tend to have a higher put option volume than what it truly deserves, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 11,000 contracts a day versus the 30-day average volume of 18,000. Regarding the open interest, the most recent volume of open interest is 93,000 contracts versus a 30-day average of 35,000 contracts. For the shareholder structure, institutional shareholders hold about 60% of the outstanding shares. The biggest shareholders include White Box Advisors, Nomura, and Vanguard. It's relevant to understand the shareholder composition of a company as it can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. This is obviously subject to a lot of exceptions since many great companies are also mostly owned by retail investors and not institutional ones, but that tends to be the exception and not the rule so far. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on. The current short interest is about 20% of the total floats, and 43% of it are coming out from outside the exchange. Overall, my opinion on a Hycroft mining holding is bullish. Because of the aforementioned reasons of potential short squeeze, the significant increase in appetite for stock reflected in its price, and the best news of all, in my opinion, is that Hymc, after all the spike, is able to actually hold at a fairly decent level without retracing significantly. The maximum exposure I would recommend is 1 to 3% of your portfolio, and for the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are very close to where it is right now. I would recommend to separate the allocation in batches of 10% at a time so that you may have enough room for later purchases. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.